There are people around the world who are discouraged from investing in real estate just because of the analyses they have to do to ensure they're making the right decision. What if I tell you that you can make a simple analysis without using calculators or computers? As Warren Buffett said, quote unquote, if you need to use a computer or calculator to figure it out, you shouldn't buy the investment. Therefore, in this video, you will learn simple ways to analyze rental properties which you can jot down in any writing material, such as scratch paper or a napkin. Please don't forget to like and subscribe, especially if you like this type of content. We always appreciate any kind of support. Welcome to EM3 Financial Freedom Strategies, where you learn how to manage your time and money to achieve financial freedom. If you want to know all the juicy details, then make sure to watch until the end. First, decide how you want to achieve your financial goals with the help of rental properties. If you want to get rich using real estate, you should first know how you'll get rich. There are two ways you can earn, either from rent or equity. This part is important because the analyses you will do depend on this decision. The following quick calculations can be done if you want to earn by collecting rent. Number 1. Gross Rent Multiplier. The Gross Rent Multiplier, or GRM, is a simple formula used to estimate the prospective value of similar properties in the same market. This formula is a good financial indicator to use, especially when rental prices are changing constantly. The formula is pretty simple. You just divide the purchase price over the gross annual rent. For example, if the price of the property is $300,000 and your annual rent is $50,000, then that means you'll get your money back in 6 years. As such, if you're going to compare this to other properties, the lower the years, the better. If you want an easier approximation, you can opt to use the 1% rule. This rule states that the gross monthly rent should be greater than or equal to 1% of the price. For instance, if your gross monthly rent is $1,500 and the price of the property is $100,000, then if you take 1% of $100,000, you will get $1,000, which is less than $1,500. This means that the property is a potentially good investment. Although other fees such as repairs and vacancies aren't included in the equation, it is still a good approximation, especially when you're pre-screening many properties. Number 2. Capitalization Rate. Capitalization rate, or cap rate in short, is a more in-depth calculation compared to GRM. The cap rate determines how fast your return will be. Moreover, you can use the cap rate to further compare the profitability of prospective properties. The calculation includes dividing the annual net operating income, or NOI, over the total purchase price. In particular, the annual net operating income is the yearly rental income minus the expenses involved regarding property management. Using numbers as an example, if your NOI is $20,000 and the purchase price is $220,000, then that means your cap rate is 9%. Suppose another property is selling for the same price, which is $220,000, and the NOI is $10,000, then that means the cap rate is 4.5%. With this example, you will think that the higher the cap rate, the better, right? That is not always the case, because having a high cap rate also means that it has a higher risk. Having a higher cap rate means that the rent is also high. The value can decrease due to some circumstances such as the pandemic. On the other hand, lower cap rates can be good too, because the low rents often rise in price in the future. Number 3. Cash-on-cash return. Real estate investors frequently apply the straightforward and effective financial formula known as the cash-on-cash return, or COC. For real estate investors, the cash-on-cash return calculates the ratio of the net cash flow generated by a property to the entire down payment. As the name suggests, COC is the amount of cash you get from the amount of cash you put in. Basically, you're going to look at how much cash you earned from your down payment. This involves opportunity cost because if your COC is low, then the deal might be bad. After all, you're going to invest the money you could have used somewhere that can give higher returns. To calculate COC, the formula is the yearly before tax cash flow divided by your down payment. For instance, you decided to save $50,000 in a bank with a 1% annual return. That means for your $50,000, you will get $500 by the end of the year. This is bad because this rate can't keep up with inflation. You could have used your $50,000 in a rental property as a down payment and potentially earn much more. Suppose the rent is $5,000 per year. So if you divide 5,000 over 50,000, then you're going to get 10%, which means that you get a 10% return to your cash per year. This shows that if you chose to use your cash on a rental property instead of just putting it in a bank, you could have earned 10 times the amount you get per year. Other than rental income, there is also equity. Sometimes you might find that earning from rentals isn't as good as just buying low and selling high. So you chose to look at increasing equity. Before going further, let's define what equity is first. Equity is the difference between your assets and liabilities, and you want this to be higher because it's essentially your net worth. If you want to earn via equity, there are several ways you can employ. Number 1. Buying at a discounted price. This is really obvious. You're going to buy at a lower price. Sometimes sellers just need the cash, so they sell at a cheaper price in a rush. Therefore, if you chose to buy at this time, you can possibly sell it at its market price or even higher. Number 2. Forcing the value to be higher. Another way you can do to increase equity is by increasing its value. For example, you bought a property with an empty house. To increase the value, you can choose to include some furniture that will help the price rise. Number 3. Letting it sit for a long time. In time, the property's value can increase as the location becomes more advanced. Assuming you bought a property in the middle of nowhere, as time goes by, there will be people who are going to build businesses around your area. This means that if you sell the property in the future, you will be able to sell it at a much higher price. This is not often advisable because you won't be able to get your money back sooner compared to the other ways you could have done on this list. Real estate is a famous business that lots of rich people involve themselves in. That's because it is profitable. So if you want to also make a real estate business, you must learn how to determine which property can give you the most profit. Hopefully this video helped you learn and understand how to make simple analyses. As always, you're welcome to share your thoughts in the comments below. If you liked our content, then please check out our other videos. Thank you for watching and see you in the next video.